Many people unfamiliar with trading think that trading on financial markets is a quick way to make a lot of money. We constantly see success stories in the news and social networks. Someone turned $1,000 into $1 million. Someone bought an expensive car or house thanks to successful investments. Everyone sees only these great stories, forgetting about the many failures associated with trading. But why does this happen? Why do many people lose money in the market? What distinguishes those who succeed from those who fail? Today, we'll look into these questions and find out what you need to know first of all to really start earning. The key factor that determines your success or failure in trading is risk management. It is what allows you to preserve your capital, avoid catastrophic losses, and create the basis for stable profits. But what is risk management? Before we continue diving into the topic of risk management, don't forget to give us a like and subscribe to the channel. So, what is risk management? Risk management is a process of managing risks in trading, a system of rules that helps traders to control and minimize possible losses. It includes setting acceptable risk levels, calculating the size of positions, and using tools such as stop losses. Many new traders chase a good profit, seeing trading as an easy way to make a quick income. They focus only on possible profits, ignoring the most important question: what loss they might have if the market does not go the way they expect. This is where risk management becomes critical. The right approach to trading is not only about being able to find profitable trades, but also about being able to properly assess and limit your losses. Risk management teaches us not to look only at potential profits, but to realize how much we are willing to lose if things don't go according to the plan. This ability to analyze and minimize losses is the foundation of successful long-term trading. Not following risk management can lead to disastrous consequences. If a trader risks too much of his capital in every trade, he will quickly exhaust his account after several losing trades. Even if he has been able to make good profits in the past, one or more bad trades can completely wipe out his accumulated capital. Let's take a careful look at the table that illustrates what happens to your deposit depending on the level of risk per trade. We'll start with an initial deposit of $10,000 and see how it changes with different levels of risk, ranging from 1% to 100% per trade. This table shows the results after 15 losing trades in a row. The first column is the number of losing trades in a row that a trader can tolerate. The other columns show how much money will remain on your deposit at a certain risk level. Green color is a low risk, 1% and 2% per trade. At this risk level, even after many losing trades in a row, your deposit remains at a fairly high level. For example, after 15 losing trades with the risk of 1%, you still have $8,600, which allows you to continue trading and adjust your strategy. Yellow and orange colors represent the higher risk, 5%, 10%, and 20% per trade. You can already see how capital is shrinking much faster, especially when the risk increases to 10 to 20%. After 10 consecutive losing trades at 10% risk, you only have $3,486 left, which shows how quickly your funds can be used up. Red shades indicate a high risk, 50% and 100% per trade. Here it is enough to have several losing trades in a row to almost completely lose your entire deposit. At 50% risk, after 5 losing trades, your deposit is reduced to the minimum values. At 100% risk, the capital disappears after the first unsuccessful trade. This table clearly shows that the higher the risk per trade, the greater the probability of rapid capital loss in case of an unfavorable series of trades. By limiting the risk to 1 to 2%, you protect your capital and allow yourself to continue to trade even in the event of a series of bad trades. However, I understand that limiting yourself can be difficult, especially when you want to make a quick profit and enjoy success. If you are struggling with this or find it difficult to adhere to strict risk management rules, I recommend you to watch our previous video, Winner's Mindset. Now let's talk about the risk-reward ratio. This is one of the most important aspects of risk management, and it determines whether you can be a profitable trader in the long term. It is best to use a ratio of 1 to 3 or higher. In other words, for every unit of risk, for example, $100, you should aim to make at least 3 units of profit, or $300 in our example. This helps to ensure successful results even if the percentage of winning trades is not too high. On the screen, you can see a table that shows how the risk-reward ratio affects your trading results depending on your win rate. Win rate is the percentage of trades that are profitable or those for which you record a positive result. Let's analyze what data we see in this table. The table shows how the profitability of trading changes at different win rate levels and risk-reward ratios. Let's take a look at what each element of this table means. The columns at the top show the win rate from 20% to 60%. Win rate is the percentage of your trades that end in profit. The rows on the left show your risk-to-profit ratio, from 1 to 1 to 1 to 5. This means how much profit you expect to make relative to what you risk in each trade. For example, a 1 to 3 ratio means that for every $100 of risk, you expect $300 of profit. What do we see in the table? With a 20% win rate and a risk-to-profit ratio of 1 to 1 or 1 to 2, the trade will not be profitable. This means that even if you have a few winning trades, they will not be able to cover the losses. At a win rate of 30% and a ratio of 1 to 3, trading becomes profitable. This means that even if you win only 30% of your trades, but each win brings 3 times more profit than you are risking, you will be in the plus in the long run. A 1 to 5 ratio is almost always profitable at win rates of 20% or more, which further emphasizes the importance of using high risk-reward ratios. So the best choice is to aim for a risk-reward ratio of 1 to 3 or higher. This ensures that you can remain a profitable trader even if not all trades turn out to be successful. For those who find it difficult to stick to such rules all the time, I have developed an indicator, OWL Smart Levels. OWL Smart Levels is a complete trading system built into one indicator. This indicator searches for trades with a ratio of 1 to 3, thus automatically guiding you to profitable trading. With OWL Smart Levels, you don't need to spend hours analyzing charts and worrying about whether you have correctly assessed the risk. The indicator will do all the analytical work for you. The indicator analyzes the market completely independently in real time, and as soon as it finds a trade that meets the set criteria, you will be notified. All you have to do is to open the trade. Take profit and stop. Loss levels will already be placed on the chart, allowing you to enter the trade instantly without wasting time on additional calculations. This indicator is designed to operate on the MT4 and MT5 platforms. You can purchase the indicator on the MQL5 website. The link will be in the description. Thanks to proper risk management, you will be able to stay in trading longer and preserve your capital. Risk management is not just rules, it is your insurance in the world of financial markets, which protects you from catastrophic losses and allows you to learn even if you fail. Over time, you will increasingly develop an understanding of the market, and your keen eye will become the key to successful trading. The longer your capital is preserved, the more likely you are to achieve a steady income and eventually become a professional in trading.